David Ellis, Director of M&A with Azets here in the Southeast. David's got everything lined up and I'm going to hand across to him. Welcome, David.
Thank you very much. Hopefully that screen has just been shared. Apologies in advance for any croaky voice. It's September, the kids are playing past the germs back at school, and for the parents, literally the spoils. But thanks, Stuart. My name is David Ellis. I'm a qualified accountant and have specialised in corporate finance since 2010. I work for Azets, which I appreciate many of you may not have heard of. Azets is a top 10 UK accountancy firm, but with a point of difference. So whereas other accountancy firms in the top 10 will typically be dealing with 100 million plus revenue clients, our bread and butter is very much the owner-managed, entrepreneur-backed SME. As with any top accountancy firm, all the services that should be expected are offered, and that includes corporate finance. And as a national team, we know what's going on throughout the country and have pretty strong international connections. In the middle of that slide, it says we focus on transactions valued up to 100 million. To be honest, if you ask any one of my colleagues, they'll quote you a different sweet spot. The majority of my transactions are within the 5 to 30 million range, albeit last week I completed on a deal that was larger than 30 million. And the week before that, I completed on a deal that was smaller than 5 million. And one of the key strengths of our corporate finance offering is the transaction service team, the guys that do due diligence headquartered in London, typically dealing with large multinational investors, private equity institutions. So we have a decent insight on what sectors are hot, what people are concentrating their diligence on. And that brings us nicely onto the corporate transactions and the role of the FD. I'm concentrating in this instance the role of an FD in a targeted business, so one that may be being targeted for takeover or even investment. And if I kick off with a typical transaction timeline, that's actually a typical transaction timeline if everything goes really smoothly and you've got everything at your fingertips at the start of the process. To put this into a perspective, last week's completed deal, a nice big 8-figure one, genuinely took 6.5 months to complete. So that's from signing the engagement commitment from the key shareholder all the way through to signing the final legal contracts. On the flip side, I'm in exclusivity on another nice large 8-figure deal, but I don't expect that to complete until around December, on which will actually have been 6 months of exclusivity, making the process 10 or 11 months overall. There are obviously a number of reasons why there's a difference in timing there, but the key one is financial information. The one that went smoothly had a finance manager that produced monthly management accounts, divisional reporting, monthly commentary, and sailed through due diligence. The one that isn't going smoothly has produced accounts of sorts, but they're largely produced by sort of a part-time outsourced bookkeeper. There's next to no analysis available on any of the KPIs, so trying to drill into whatever may have happened in any particular month in any particular service has just been a recreation of the wheel exercise and extended the timeline. So hence the 6 to 7 month process is everything going to plan. And as I say, what makes it take longer is usually the record keeping, and it's usually financial. And I'll come back to this slide. But what it means is the preparation actually starts a long time before that transaction process. Now I appreciate in this slide I'm going to be preaching to the converted, but the reality is a lot of financial teams within companies simply does what the MD wants. And I've worked with and known MDs who simply look at their cash balance and sales targets on a monthly basis, and that's good enough for them because they've got a good feel of the company and they know what it's doing. And it may well be good enough in the event of a trade sale, so in a transaction where you're dealing with someone who's already operating in your industry, knows how the industry works and probably what makes your company tick. But frequently transactions nowadays often involve private equity, and even that trade player may have a financial backer in the background that needs the tools at their disposal to green light a deal and also to actually offer top dollar in the negotiation process. And it's a bit of a crass analogy, but think of when you're selling your house, before you invite estate agents and potential suitors into your house, the likelihood is you've tidied everything up, you've given the house a lick of paint, and you may have even upgraded bathroom and kitchen. It's the same in a corporate transaction. If you're touting for investment or looking to be taken over, it helps if your business is tied up in a nice, neat bow and handed across to the diligence providers, handed across to the would-be buyer. Because then there are no lines blurred between whether you're buying what the buyer is buying, whether it's the business or whether it's just the expertise of the managing director. In order to have it tied up in a nice, neat bow, managing director is typically needs to be made redundant, and the keys to the chess, the keys to the process, often lie within the financial information. So again, I appreciate I'm preaching to the converted, but monthly management accounts are absolutely critical. And ideally with a full sort of mirror year-ending close in each monthly management account occasion, so full balance sheet, accruals, prepayments, and the reconciliations that go with that. Financial statements are often out of date the minute that you prepare them, let alone by the time someone actually comes around to look at them. Monthly management accounts means that if you've been preparing them from the year dot, then you can give a more accurate 12-month picture, even a 12-month outlook. There's budgeting involved as well, and again, it benefits you in terms of when due diligence actually starts. All of this analysis that has been done, as a matter of course, can be handed over to the financial diligence providers, meaning you can get on with your day job. A corporate transaction is usually an extracurricular activity. Everyone has their day job to do. In the meantime, there's a lot of people asking a lot of annoying questions. And also during the transaction, conversations will often center around net debt, net cash, normalized working capital, and other statements like these. If proper monthly management accounts are done in the ordinary course, it makes these conversations a complete breeze. But monthly management accounts just give you the monthly results. I'd also think about KPI reporting and what makes your business tick. For instance, divisional reporting, business to business versus business to consumer sales, or geographical regions. For instance, may well be that the Southeast experiences tighter margins simply because of the volume of competition versus what you may be able to get away with charging and the margins you make in more rural areas. Different products and service. I can demonstrate that this group of products makes a higher margin than that group of products. And customer analysis, there's a particular reliance on this one customer. And you may well be thinking, what's the point in doing all of this? Because the owner manager, he certainly doesn't bother looking at all the analysis that I provided. Well, it's beneficial in twofold. One, I've already mentioned. When it comes to due diligence, particularly when there are a lot of financial backers involved, they will ask for song and dance about the company. And if it's not available, then they will ask, can it be available? Can we go back and start recreating the wheel? Which is a massive pain, especially when you're trying to carry on with a day job. And the other reason is that it can actually be extremely beneficial in the marketing and negotiation phase. Different products and services I mentioned. For example, a software business. Software businesses typically have a number of revenue streams, such as subscription revenue and consultancy revenue. Subscription revenue commands a far higher transaction multiple than consultancy revenue. If you're able to accurately produce and demonstrate divisional reporting, then it means that the buyer can confidently offer top whack multiple on what they want to buy and a decent multiple on the rest of the business. I mentioned budget. No matter how disparaging I may have been to business owners, and that's not a generalization, I know they're not all alike, and a lot of people are heavily involved in the finances, so apologies for that. But every business owner will naturally have sales targets, and they'll be tasking their key salesmen, key account managers with appropriate sales targets. And this means that budgets can therefore be produced by making some assumptions on margins and the knowledge that overhead base is relatively fixed. And that gives you a clear picture of where the year is going, because you can overlay those monthly management accounts on top. So rather than negotiations being centered around the financial statements to March 2023, you can accurately demonstrate the 6-month actual results to September, the 6-month reasonable budget to March 24, and therefore we can start having negotiations on the results to March 24 as opposed to a year out of date. I've been banging on about the financial side. I appreciate that finance directors often have more than one hat on and are tasked with looking after other areas of the business, such as payroll and contracts. Financial due diligence is obviously key, but legal due diligence in a transaction is also key. And legal due diligence will often sort of centre around contracts, and the key contracts usually involve customers, suppliers, but above all, your employees. Does everyone have an up-to-date signed employment contract? Are we going to have any problem with any employees transferring over? And it's worth checking the property as well, checking whether there are any break clauses or, in fact, when the lease expires. None of this is meant to be a recreation of the wheel in terms of the preparation that, the requirements that are ideally suited to a corporate transaction. I'm making an assumption that different businesses offer different products and services, and therefore I'm expecting that businesses charge different rates for different products and services, and the invoice probably says the different products and services that are being charged at different rates, and therefore if the invoice says it, the accounting system can cope with different information which can filter through to the monthly management reporting. So I'm not looking to completely recreate the wheel and say you should be doing loads more analysis on a monthly basis. It's just using the tools at your disposal and your knowledge of what makes the company tick, so what you think the ultimate owner might benefit from and what a institutional investor, potential buyer, would-be exit process would potentially benefit from. And revisiting the timeline, it's often those latter two arrows that are most likely to be stretched dependent on financial information. In terms of collating the information, well, if a shareholder is hell-bent on going to market or looking for an investor, then that can be done in fairly quick order. But in terms of financial information, that will come up very, very quickly in terms of going to market and negotiations. And if the information just isn't there, then all you're doing is kicking the can down the road to when it eventually lands in exclusivity and due diligence, where it may well be that more and more questions start to be asked. And as I said, it will help during the negotiations in the second phase if you're able to adequately demonstrate this is how well my business is doing now versus what was previously filed at Companies House a long, long time ago. Lastly, I'll touch upon the aftermath. Again, I said I've concentrated on the role of transactions when the business is being targeted or being acquired. There's a common misconception that following an acquisition, the finance team has a target on their back. Yes, that can happen occasionally, but also the complete opposite could happen, subject to due to how impressive the diligence process was, thanks to the all singing, all dancing monthly reporting that was on show. And in any case, your new investor, new acquirer will need to know how well their new investment is doing, and therefore will need monthly reporting requirements, which may well be just topping and tailing what is already done. I've put earn-out performance in there as well. It's extremely unlikely that a shareholder achieves 100% of their value on day one. A lot of consideration is often deferred, and a lot of it's going to be contingent. And the contingency is usually set upon financial hurdles, and therefore earn-out performance and accurate reporting is key. And who better to be reporting on that than the shareholder's key ally, which was his finance manager at the time. And in terms of future prospects, having a successful exit process on your CV is such a significant feather in your cap. And I mentioned that it's a common misconception that you get a target on your back if a business is acquired, and it can happen. But to give you an example, in 2021, a fire safety business was acquired by a private equity-backed company. They immediately made the finance manager redundant. My colleague was well aware that he had a client that was in need of a new financial director, had no hesitation in recommending this person. He completely revolutionized the monthly reporting process. 2 years down the line, that was the transaction that completed last week. And the difference is, in this case, it was a foreign private equity buyer investing into the UK. This finance director is now going to be at the forefront of a UK platform and any new UK reporting requirements, any expansion, which will probably actually involve acquisitions of his own. So, as I say, having a successful exit process in your CV is a significant feather in your cap. That was a whistle-stop tour of requirements of a corporate transaction. There's a handsome chap on that slide, but if anyone's got any questions, then I'd be delighted to hear them.
Thank you, David. That was really, really informative, and obviously we're open to questions now. We can either type them, depends how quickly, or if you've got a question, just put a hand up in the chat, or I'll just try and manage those questions to David. So who's going to be brave and go first?
I'll go.
Tim, over to you.
Hi, yeah, David, thank you very much. So generally within companies like FD, we do standard cash flow forecasting and month-end reporting, which would be P&L and balance sheet, but sort of a three-way forecast projecting P&L going forwards over the next month to year end or 12-month period. Is that more what you would be looking at, that we should be doing on a regular basis, on a monthly basis?
So I will continue using the example that that successfully completed last week. So they have an annual budgetary process whereby all the key account managers, all the key salesmen are tasked with, you're looking after these clients. This is going to be your sales target, which gives them a top line. From then on, they had a relative good handle on the direct costs and the overhead base, which gave them a full year financial budget for the a full financial budget for the financial year. And this was simply overlaid with actual results as and when they came through. So it meant that when they said, we're going to make £15 million of revenue, £4 million of profit, I can back that up because we're slightly ahead of where we were going to be when I said we were going to do that, and the outlook actually is 4.1 million. If it turns out after a month, 3 months, 6 months that budget is wildly out for whatever reason, either you're grossly overperforming or underperforming for whatever reason, then I would have a think about a rebudget, simply because it's already proven that budget is not accurate. But generally speaking, doing it in a couple of months in advance of the financial year and then just overlaying it to see how one is progressing, I think is more than adequate. It's only when you start wildly deviating from said budget that you should think about a reforecast period. It also, and sorry to continue rabbiting on, it also depends what the objective is. Again, I touched upon private equity investment or investors. If there is investors involved, they're always going to be keen on a 3 to 5 year period. That's budgeting for a specific process. What I was talking about initially was just what I think is beneficial in the ordinary course of business. In the ordinary course, just a simple annual budget and overlay that.
Yeah, thank you. I mean, I think yes, that is something we do. We do the planning of that, and then I would say on a monthly basis is cash flow monitoring, P&L analysis. But realistically, they're not looking to sell, but they would be, as all directors, they want to know how much money they can take out at the end of the year. So they're also planning for that.
Absolutely, and not everyone is looking to sell. And so one of my colleagues, actually, a corporate finance guy in Scotland, has done an article this morning where he sort of pointed out that the majority of the transactions that we come across are when people are not looking to sell. And if you've got the tools at your disposal, because a lot of stuff is just done in the ordinary course, then it's makes it a lot easier for any kind of decision making on both sides.
Brilliant.
Well, thank you.
Anybody else? Questions for David?
Yeah, David. Hi. I hope you have some clairvoyancy skills. We're a business law firm, so we buy and sell a lot of businesses for our clients. And there is always a rush up to the end of either tax year or financial year with an impending likely change of government in this country, are you expecting to see vendors cash in and run for the hills? And again, accepting that the tax tail should never wag the dog.
Okay. I mean, last comment aside, yes. So it was trying to think March 2021, where everyone was extremely paranoid that Entrepreneurs Relief was going to be scrapped in its entirety. And that just resulted in a complete barrage of transactions being pushed through, almost forced through, before that mini budget or budget came out, budget announcement. As it was, they didn't touch capital gains tax rates, but the rumours in the run up to Christmas were so strong, then it had the effect of a lot of corporate transactions. So the answer to your question, yes, I do think there will be a lot of activity on the basis that there will probably be a change in government. For what it's worth, I'm not convinced they will look to change or overhaul capital gains tax rates immediately. It will probably be on a focus, but again, I wouldn't really want to second guess. And going back to my initial answer, yeah, I do think there will be a little bit of a rush in the run up to that.
Okay. Yeah. Thank you.
Stuff. So we've got a question from Mark Thompson in the chat. Is that something you want to ask directly, Mark?
Something about sell-side due diligence.
Yeah. So if you want to go ahead with that, if that's enough information for you.
It definitely has its uses. I'll be honest, it's something that I see on much higher value transactions. Apologies. Much higher value transactions, so 50 to 100. Certainly when it's done in view of a process where you're expecting a lot of, again, equity investors to get involved. Much further down my side of the market, where I mentioned my sweet spot of transactions valued between 5 and 30 million being my sweet spot. I think it's less of use. The buyer is going to use their own external diligence, whatever the weather, and therefore, in my opinion, sell-side due diligence does add value because it certainly gets one ready for the process that's going to be gone through in terms of digging out all the information and passing it across. But on the flip side, if you're going through a process where you're definitely preparing yourself, readying yourself for sale, these are the sort of questions that, for instance, I would ask anyway, and putting forward an information memorandum pack where there'd be information, on an anonymized basis about customers, suppliers, margins anyway. So part of my process in getting company sale ready would be asking very similar TS questions. As I say, the vendor sale side due diligence, I really only see on very, very high value transactions. So yeah, one of my colleagues is doing a close to 100 million deal acquisition at the moment, and there's vendor due diligence involved there. But I can't remember the last time I saw one on sort of a 10, 20 million transaction.
Cool. Hope that answers your question, Mark. We've got a question regarding discount rates and multiples from Andrew.
Thanks, Stuart.
If there's any...
Just to sort of flesh that out a little bit.
Excellent, that's great.
Let's get working from there. So obviously we've had quite a hike in interest rates over the past sort of year or so, and that's obviously having an impact on the discount rates that get applied when you're doing the discounted cash flow and terminal value calculations and things. I'm just keen to get your steer from seeing it from an advisory perspective, whether that's also flowing through into an impact on the typical sort of revenue and EBITDA multiples that are getting used as well.
So yes, interest rates have gone up. Talking to Stuart about this beforehand, I had a debt-backed management buyout that management team called quits on sort of a month or two ago, simply because the cost of debt was too high, and pairing that with all the financial due diligence and the rigmarole of going through a transaction, they basically put it on hold for a while. Discount rates I have to pass on. I'll be honest, it's something that I remember vividly from my accountancy exams. It's something that I maybe apply to in a real world scenario once, maybe twice a year. In terms of multiples, not really seen interest rates have any effect on multiples. And this is because the majority of transactions are typically, the ones that we come across are driven by, say, private equity money, where people have looked to put their money in, private equity funds instead to get their return, as opposed to any kind of debt-backed institution. And if anything, after a quiet start to this calendar year, activity in certain sectors has certainly ramped up, and I'm seeing sort of multiples be fairly strong. My honest answer is I haven't seen multiples have had too much effect from the increase in interest rates.
That's good to hear. Thank you. Appreciate that. My thoughts were, my concern was that the higher interest rates would be sort of the higher risk-free rate, and that would have a bearing on what people were prepared to pay for an acquisition. But no, good to hear that multiples have remained strong.
Yeah, I think transactions, be it trade multiples or private equity platform investments, they're always going to be based around when on a private equity level, maybe sort of the IRR that they've got, a minimum IRR that they're looking for, or simply when we want to see a return on our money. And as long as if bank debt is being ploughed in, then yeah, it's probably going to be a longer return before they see that. But no, I haven't seen too much effect from it yet.
Thanks for that.
Good. Any other questions? Some great stuff going on here.
I do have another one. No, you go first, Jodie, because I already had one question.
Okay, thank you. Hi, David. Just a quick question on the recipients. If your company's, if someone's interested in it and they're a PE business versus a kind of a private or transaction, is the process vastly different, or are the data requirements any different?
The process is not vastly different.
Okay.
Simply because there will definitely be an onus on historical financial and legal due diligence, making sure compliance is in place, but also trying to understand what makes the company tick in terms of historic margins, etc. The differentiating factor in terms of financials in an investment scenario, there will certainly be a lot more onus on. So there'll be more onus on what we think is going to be happening in the future, and what that is based on. Because you need to understand the historics first, and then look to how that's being applied to the future. What are the growth prospects, etc. What are the margins going to be, and indeed what are the cash flows? Are there any cash pinch points from A, my investment, and B, the working capital requirements of scaling up the business. So on the legal side, there'll be a lot of differences as well, because shareholders agreements, investment agreements will be added in or overhauled. There'll be a lot more legal paperwork to go through. But on the financial side, no, there's still going to be a big onus on historics, with just a tad more on forecasts.
Tim, I think you had something else you wanted to jump in with?
Yeah, David, forecasting system. Now, I suppose I'd imagine a lot of the guys here, certainly on the accounting side, will be using Xero, QuickBooks, etc. There are a number of cash flow forecasting tools around. QuickBooks one's not particularly great, but I like Float. But when it comes to actual forecasting systems, are there any that you've seen that you like, that you, a suite of systems that you like and feel that provides the finance director, and then obviously helping the board, but obviously then providing the information to the buyers? Then any sort of suite of systems that you feel really good?
No, Tim, I'm going to have to come back to you on that one. I'll be honest, that's the forecasting systems probably wouldn't be my area of expertise. I see a lot of it done on Excel, but probably built from a P&L forecasting system. But still, I see a lot of it, as I say, built on nuts and bolts on an Excel model. But I'm happy to come back to you on that if you'd like some of my colleagues' views on it as well.
Yeah, I mean, I'm using one that I won't give the name just in case it's one of the ones you either like or don't like, or they like or don't like. But yeah, what it will do, it will pull the information out from Xero and QuickBooks. It'll put it into Excel. Then you can then hit a button and it comes out a nice sort of PDF format as well.
No, that's interesting, but I'm not going to try and blag my way through that one. I don't have I can come back to you on that one.
Great, thank you.
Politician, we like that. So Vanessa's just put in that Castaway, pretty good and inexpensive. I'm presuming that's in response to that question. Any other questions? It's all great stuff. I'm just having a look through people's faces. No, I mean, we're not going to, keep going if we don't need to. So if there isn't any other questions, obviously formally want to thank David for a great session, some free advice there, which is generally quite hard to get out of people. We're here afterwards, by email, LinkedIn, whatever method you want to use to get in contact if there is anything that comes to you later. We're happy to do that, but I'll wrap the session up. We'll send those emails out afterwards. They'll come out from our marketing team. And we'll help in any way that we can. But thank you, David, for your time today. I look forward to catching up with you very soon. And thanks for everybody attending. Keep up to date with us. We do run virtual boardrooms. We also run smaller sessions for FDs on a monthly basis as well. And we look forward to seeing you there. Lots of familiar faces today, which is always good. So have a fantastic rest of your week, and we'll catch up very soon, hopefully.